Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 153. And in this episode, we're reviewing the performance of the global markets during the 13th week of 2025, and that is from Monday the 24th to Friday the 28th of March. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where on Friday, the Commerce Department released the latest inflation data that showed consumer prices had risen more than expected in the month of February. The Federal Reserve's preferred measure for inflation, that is the Core Personal Consumption Expenditures Price Index, showed a monthly increase of 0.4%, which was the largest monthly gain since January 2024. Meanwhile, the annual rate of inflation came in at 2.8%, which was a tad bit higher than the consensus forecast for an increase of 2.7%. For your information, the Core Personal Consumption Expenditures Price Index excludes volatile food and energy prices and is generally considered a better indicator of long-term inflation trends because it adjusts for changes in consumer behavior. Staying in the United States, on Tuesday, the Conference Board released a consumer confidence report for the month of March, which showed a significant decline as the outlook of future economic conditions fell to its lowest level in more than 10 years. The monthly confidence index slipped more than 7 points to a reading of 92.9, which was the fourth consecutive monthly contraction. At the same time, a report by the Bureau of Economic Analysis showed that consumer spending accelerated by 0.4% in the month of February, as personal incomes posted a rise of 0.8%. For your information, the monthly confidence index measures consumers' outlook for income, business, and job prospects. In a summary, according to various consumer sentiment surveys undertaken recently, there is a growing concern that the U.S. economy may be sliding into a recession. And given the central role that the U.S. occupies in the global economy, a recession in America will definitely have repercussions across the globe. And in the ongoing tit-for-tat tariff war, on Wednesday, President Trump announced a 25% tariff on all cars manufactured outside the United States. According to the Trump White House, the new tariffs will come into effect on the 2nd of April and will apply to all foreign-made cars and light trucks. This decision has already dented auto stocks and raised concerns about an economic slowdown. In the United Kingdom, according to data released by the Office for National Statistics, the annual rate of inflation in the UK fell slightly to 2.8% in February, and this was down from 3% in January. Economists polled by Reuters had anticipated the consumer price index to come out at 2.9%. Meanwhile, core inflation, which excludes volatile food and energy prices, this rose by 3.5% in February, down from 3.7% in January. On Wall Street this past week, there was a massive stock sell-off on Friday that was triggered by uncertainty around the United States trade policy and its impact on inflation and the possibility of a looming economic recession. Stocks were in reverse gear on Friday after the consumer sentiment report for March indicated the highest long-term inflation expectations since 1993. The 30-stock Dow Jones Industrial Average shed about 0.96% for the week and was down by 715 points on Friday to settle at 41,583. Meanwhile, the S&P 500 lost about 1.5% for the week and dipped by about 1% on Friday to close the session at 5,580. And the tech-heavy Nasdaq Composite declined by 2.6% for the week, with a massive plunge of 2.7% on Friday to eventually level out at 17,322. Please note, the Nasdaq is now on track for a monthly decline of about 8%, which would be its worst monthly performance since December 2022. In the government bond market, the yields on U.S. Treasuries fell on Friday, even after the latest inflation data showed persistent price pressures, which suggested a correction in the U.S. yield curve. The annual rate of inflation, as measured by the core index, came out at 2.8%, which remains significantly higher than the Fed's target rate of 2%. This data highlights the challenge of persistent inflation, which suggests that monetary policy may need to remain higher and for much longer than originally anticipated. The yield on the benchmark 10-year Treasury bond declined by about 12 basis points and was last seen trading at 4.25%, whilst the yield on the policy-sensitive 2-year Treasury note fell by 9 basis points, down to 3.90%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equivalent to 0.01%. In the crude oil market, the price of crude was on track for a third consecutive week of gains, but dipped slightly on Friday on worries that U.S. tariffs could spark a global recession. President Trump has indicated that effective the 2nd of April, he plans to implement reciprocal tariffs targeting a wide range of imported goods. This action is likely to escalate into a trade war and eventually lead to a global recession. On a weekly basis, the price of Brent crude gained about 1.9% to settle at $73.63 a barrel, whilst the price of the US benchmark, that is West Texas Intermediate crude, rose by 1.6% to close at $69.36 per barrel. In the precious metals market, the price of gold surged to a record high on Friday as investors flocked to the safe haven asset, driven by fears of a global trade war triggered by the latest round of US tariffs. Ongoing concerns about tariffs and a potential global trade war continues to drive safe haven demand for gold, which is broadly viewed as a hedge against economic uncertainty and also tends to thrive in a low interest rate environment. The price of spot gold hit yet another record high at $3,086 and was on track for its fourth consecutive week of gains as it rose by 1.7% this past week before settling at $3,074 per ounce. In the cryptocurrency market, during the week, cryptocurrencies tumbled across the board in tandem with the stock market. Bitcoin was broadly flat for the week as concerns about additional tariffs continued to rock the markets. The flagship cryptocurrency was on track for its first 3-week slide of 2025, and according to CoinMetrics, the price of Bitcoin was down by more than 3% and was last seen hovering at around $83,000 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling remained static versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.37 compared to 129.38 that was recorded the previous week. Meanwhile, the sterling pound was priced at 167.22 and the euro was valued at 139.37. And on the regional front, one Kenya shilling was changing hands for 28.34 Ugandan shillings and 20.37 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.89. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any unforeseen circumstances, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the shilling still remains negative, and this is evidenced by the country's excessive national debt that now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves decreased by $45 million for a grand total of $9.95 billion, which is equivalent to 5.1 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the Central Bank of Kenya does not provide any explanation for the change in foreign exchange reserves. In the money markets, the interbank market was sufficiently liquid during the week and was also supported through open market operations, which remained active. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is the rate that banks lend to each other on an overnight basis, this was relatively stable at 10.66% compared to 10.64% the previous week. And in terms of volume, the average value that was traded in the interbank market, this increased to 12.2 billion shillings, up from 11.6 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 16 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 27th of March, and the central bank received bids totaling to 14.74 billion shillings against an advertised amount of 24 billion shillings, representing a performance of about 61%. The central bank, however, ended up accepting only 14.5 billion shillings, and the results of the auction were as follows. The 91-day rate fell by about 5 basis points to average out at 8.79%, whilst the 182-day rate dipped by 2.7 basis points to level off at 9.05%, and the 364-day rate was down by about 5 basis points to settle at 10.41%. And just as a reminder, in the primary bond market, the Central Bank of Kenya has published its prospectus for the April bond issue and is looking to raise a total of 70 billion shillings for the stated purpose of budgetary support. And the central bank is therefore inviting bids for the following 3 reopened treasury bonds, whose terms and conditions are as follows. The first bond is a 15-year bond issued in 2020 with 9.9 years left to maturity and a coupon rate at 12.75%. The second bond is another 15-year bond issued in 2022 with 12.1 years left to maturity and a coupon rate at 13.94%. And the third bond is a 25-year bond issued in 2022 with 22.6 years left to maturity and a coupon rate at 14.18%. Please note that these bonds are now open for sale until Wednesday, the 2nd of April, when the auction will be held. At the Nairobi Securities Exchange, during the past week, the equities market recorded a mixed performance, with the NASI and the NSE 10 each gaining by 0.5%, whilst the NSE 20 and the NSE 25 fell by 0.8% and 0.1% respectively. This takes the year-to-date performance to gains of 8.2% for the NSE 20, 4.4% for the NASI, 2.2% for the NSE 25, and 1.1% for the NSE 10. The market's performance was driven by gains recorded by large cap stocks such as Safaricom, which rose by 3.1%, whilst Stanbic Bank and Absa Bank both gained by 1.1%. This performance was however weighed down by losses recorded by other large cap stocks such as DTB Bank, East African Breweries, and Standard Chartered Bank, which declined by 5%, 2.8%, and 1.6% respectively. Up next is our topical issue, and this week we're looking at Kenya's request for a new IMF funding program. According to Bloomberg News, Kenya failed to meet its revenue requirements stipulated by the International Monetary Fund, and that is why it did not receive the ninth and final tranche of the $850 million under the current program. In an effort to spin the outcome of the review, the Treasury Cabinet Secretary said that both parties had mutually agreed to walk away from the ninth and final review, mainly due to time limitations, given that the current program was set to expire in April 2025. The ninth disbursement of $850 million was the last tranche under the current program of $3.6 billion that was approved under the Extended Fund Facility and the Extended Credit Facility programs. The Treasury Cabinet Secretary denied reports that Kenya had fallen out with the IMF over the government's failure to meet some of the targets set out in the current program. The fact of the matter is that Kenya continues to struggle to rein in its fiscal deficit and to boost revenue collections, which are two of the main requirements set out by the IMF. Without skipping a beat, Kenya has already applied for a new lending program from the International Monetary Fund that will factor in the last tranche from this current program. The IMF has confirmed that it has received a formal request for a new program from Kenya and will engage with the National Treasury on this application. In relation to the foregoing, S&P Global Ratings said that any missed disbursements from the International Monetary Fund could complicate Kenya's strategy of lowering its debt servicing costs and could also delay funding from other sources. For your information, IMF funding is often seen as a vote of confidence and serves as a catalyst for other sources of funding. And therefore, any negative signals from the IMF could put into jeopardy Kenya's planned borrowing for the first half of 2025, which includes about $800 million from the World Bank and a further $1.5 billion from the United Arab Emirates. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please consider supporting this podcast by becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, and that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the stock market is designed to transfer money from the active to the patient. Think about it. Thank you and God bless.